So in this video, I'm going to break down everything from my weekly trade metrics to going over 3 trades that I took this week. And lastly, going over some top lessons and things that I learned this week that I want to take on to next week. As you all know, this is for education and information purposes only. I'm not a financial advisor, and all of this is just my experience. When we take last week's metrics, I took around 13 trades. Out of those, 11 were winners, giving me a win rate of 85%. My total P&L was 3,787 with an average trade profit of 291. I kept my risk tight at around 3% per trade, and my average risk to reward ratio came in at 1.58. Most of my wins came from clean 0 DTE credit spreads or breakouts while I was scalping. My average trade was a 4.5 DTE, but keep in mind, I'm pretty much focusing on same day expiration. So even though I'm getting into longer term trades, if you look at my trade length here next to DTE, the trade length is very small, right? So I'm entering a credit spread and I'm leaving that day. Now let's look at the trade review. So I'm going to take a look at 3 trades out of the 13 that I took last week. We'll take a trade 682, which was a credit spread on RUT, the small caps. I'll take you guys through my mindset of the iron condor that I played with NDX or QQQ. This was during the Trump reciprocal tariffs day, so playing an iron condor was a unique way to make some money from that news. So those were the 2 wins. And lastly, I'll go over one of my credit spread losses. Before we go through the actual trade, I want to walk you guys through my process that I use. I call it the 5 Ps. And I think the goal with these videos isn't just to show you the wins or losses. It's to show you think through trades where I can improve and teach myself through repetition. So let's get into it. The 5 Ps is a personal strategy that I developed to approach every trade with structure and consistency. I learned that when I follow this framework consistently, I not only stay profitable, but I also avoid unnecessary mistakes, just like I'll show you with the last trade. I'll most likely do a deeper dive video into the 5 Ps, but for this video and for these purposes, I'll just go over what the 5 Ps stand for and we'll go through the trade. So the 5 Ps stand for phase, pattern, price action, plan, and patience. Each one keeps me grounded in my process no matter what the market throws at me. So let's go over phase. The first step is understanding the phase of the market. What kind of day it is. Is the market trending, consolidating, volatile, or flat? So if we take a look at RUT in the chart on the left, let's just make it one chart right now and take a look at RUT on the daily. We can see that the last 10 days almost, we've been having this nasty sell-off. Even since February 19th, February 21st, we had definitely in a trending day, trending down. So if we take a look at the trade, now let's look at the trade. I use these light blue arrow marks to identify where I entered the trade on the 5-minute time scale. And I have my break-even line showing the difference in my spread, right? So the break-even line is a line where if price stays above the break-even, I can collect full profit on my credit spread. But let's take a look at RUT and what actually happened. So this trade happened on a Friday, right after a massive sell-off of RUT the day before. You can see by the gap down and then continuation of that day that we're in a nasty bear market in a way. Supply is taking over and demand is getting killed. So this is coming right after one of RUT's biggest sell-off days with heavy volume. So coming into the day, I'm already thinking we could potentially see a bounce because my thinking is, how far are we going to continue to fall with these names? So around 11 a.m., I saw a strong volume spike and a price surge in IWM. We then we pushed to the new highs of the day, and this was my signal. This was the market phase shifting from bearish to bullish. I started to think about counter trend trading opportunities. This could be the start of a reversal or at least a pause in the downtrend. So I'll show you guys what I'm seeing with IWM, because RUT does not show volume. However, RUT and IWM both follow the small caps. So when we take a look at IWM, you can see how the price action looks very similar to RUT. However, I trade RUT as opposed to IWM because I get a little bit better spread with these contracts, and they're a bit more expensive. And the pre-market, it's already dropping, so that's interesting. However, if we take a look at the trade, you can see this bullish engulfing candlestick on the 5-minute with pretty good volume, as well as price coming back to take on new highs of the day with volume. So this is when I say you really have to take a look at the phase of the market. You have to understand if the market is trending up, trending down, is it consolidating, is it flat, is it volatile? So we're definitely volatile, but my personal opinion is that we just reversed with this bullish reversal candlestick pattern of the bullish engulfing candle and then the volume spike increase. So my psychology has already changed. Let's go back to RUT. So the next part of the 5 Ps is, first we have the phase, next we have the pattern. When I look at the pattern, I like to look at the pattern on the 5-minute basis as well as the hourly chart. However, the 5-minute basis will show me exactly when I need to enter the trade. The pattern I saw forming was a classic V-shaped bounce. This was confirmed by a strong volume spike and a bullish engulfing candle at 10 a.m. A textbook reversal. Even though the previous day was extremely bearish and we opened near the lows, this kind of action told me to start looking for counter trend opportunities. So I waited for the first pullback, and once a bullish candlestick formed off that level, I got interested. I could have waited for a bull flag confirmation, which actually came later that day, but I had enough data to justify this trade. Let's take a look at price action, and then we'll get into the entry. So price action, for me, retracements are the most important part of price action. I use Fibonacci levels to identify ideal pullback zones, specifically between the 38 to 61 Fibonacci range level. In this case, we got a clean 50% retracement from the low and the high of the day, and this was my first check. So for example, if I take a look at the chart and go to the 5-minute right here, I entered around the 50% retracement throughout the whole day. And when I entered that trade, let's take out this Fibonacci level, and you can see my break even was just above the bullish engulfing candle, right? So when we take a look at price action and the pattern, I knew that, okay, I'm going to take a counter trend trade. And for my price action, I'm just waiting for this retracement, right? So the goal isn't to buy this breakout, right? This breakout is just confirming that that demand is back into the market. So never buy this first breakout, buy the pullback. And this pullback was a 50% pullback. And I decided to buy the first green candle and put my credit spread right below the bullish engulfing candle. Lastly, second to last in the 5P strategy is patience. Patience starts before setups even form. From 9:30 to 10, I sit on my hands and I watch the open. I look at how major indices react relative to the previous day, and I monitor the macro picture, the VIX, yields, technology, energy. I do all of this to get context in the market. So for example, once I saw IWM starting to form the reversal pattern, I did not rush in. I waited for price action and my 3 confluences to happen. So I received the Fibonacci retracement. The second check was a bounce off the 9 and 20 EMA, and the third was a trendline break between the reversal. Lastly, I also had the bullish candle on the EMA, this bullish reversal candlestick pattern. So those were my confirmations to go in. When we talk about plan, I entered a put credit spread, which is a bullish pattern, which is a bullish trade. Essentially, you can see with the first arrow, I entered at around 11:43 a.m., putting my break even at around 1800. And you can see throughout the day, even though we declined almost to my break even level, once we had this push up, I was able to sell the credit. However, this trade gave a lot of lessons. This trade worked out, but it's a perfect example of why I love credit spreads. They're a forgiving strategy, and you can also manage the trades well. Even after my confirmations, price continued to retrace and actually cross my sold strike price. Right, as you guys see, price continued to come down. However, I stayed calm, managed the trade, and sure enough, demand came in and bounced back, and I was able to sell the trade for a 62% profit. I have held for full profit, sure, but for me, it's not worth the risk. The more profit you're in on a credit spread, the more risk you're exposed to. I'll rather exit early and compound consistently than hold and gamble. So again, the learning lesson with this trade is be a little bit more patient on the confirmations, but sometimes you just have to get into the trade and manage the trade while you're in it. Because this trade wasn't as smooth and it still pulled back, I was able to manage the trade and collect 62% on this trade. The next trade is trade 678 on NDX, where I played an iron condor, profiting $980 on the trade. Let's run through it. I used a unique strategy for this trade. I'll give you guys a breakdown of what I was thinking, what the dynamics were before the trade, and how I executed the trade. So with this trade, I used it for Trump's Liberation Day announcement. This was a high conviction play, and honestly, my only regret is not increasing risk. I saw the setup and I knew we'd get movement, and we did. For those who don't know, an iron condor is when you combine a call spread and a put spread on the same asset. Essentially, with these spreads, I'm playing volatility expansion. I'm expecting a big move in either direction, and this setup gave me defined risk with a wide range of profit. Essentially, this spread is saying if the market goes up 3%, I can make money. If it goes down 3%, I can make money. The one thing it can't do is it can't stay the same. Price can't be in this range. That's where I'll lose money. However, this is a good trade because I'm basically trading the news and expecting big movement, which is exactly what we got. And now let's take a look at the 5 Ps when it comes to this trade. Now, for most trades, I care a lot about the market phase, but in this case, I'm trading both sides. So the phase doesn't really matter. We can be trending, consolidating. However, with an iron condor, you really want to be trending. That being said, when you zoom into the daily and the 1 hour, the market has been downtrending, as we can see, since March 25th and even well before that. But on this day, we opened lower and started buying back with strong demand, even filling the gap, pushing beyond what we had before. Right here, right? So on the 31st, we opened very low, came down to 18,700. However, we continued to fill the gap right before the news. Price ended up being in between this blue box. I would have lost money. So I entered on the 2nd and I sold the next day, as this was a 1 day to expiration. Now let's take a look at pattern. I saw a bear flag forming on the chart and actually expected more upside. So we had this downtrend and this retracement, making higher lows and higher highs. So I was actually thinking that we might continue higher. But with this trade, I could play both sides. And the next day, we just continued to drop and I was able to profit. I'll probably do more videos on iron condors. I don't trade them as much. Trade 671 was on SPX where I had played a put credit spread. However, this trade was a $420 loss. So in this trade, you can see my first arrow, which is here, playing a bear, playing a call credit spread. So I'm thinking that the market will continue to go down. As you can see, I was very wrong. Let's take a look at phase. We were clearly in a downtrend on both the higher time frame and lower time frame, but the recent days were both positive trends. The market had already shown a little strength in the vast realm of weakness in the previous weeks, and I came in looking for that continuation lower after a gap fill. The phase told me if this breaks clean, we could get a follow through, but you can clearly see I was trapped. One thing about entries for credit spreads is you have to have tight entries, and you especially have to be in the right direction. So when we take a look at the top 3 lessons learned from this week, I think we could say that patience pays. Waiting for my setups, not forcing trades, and honestly, waiting until 10 a.m. before every trade comes, watching what the market does, watching ETFs, understanding what price is doing. Next, I would say trade what you see and focus on the index that you're analyzing. So if you're looking at QQQ but then playing SPY, or looking at SPY and playing small caps with INW, it's not going to work, right? Focus on the symbol that you're trading and only focus on that symbol for the day. Lastly, the biggest lesson is to just have a trade plan, right? Set profit targets, understand your trade, manage the risk. That's going to conclude this week's breakdown of Chinedu trades. Last week, I made around 3,700, 3,800. Going into this week, I want to continue to follow my plans, continuing to be patient and taking what the market gives me. If I do that, I can continue to hit my weekly goal every week. Lastly, if you guys have any comments on the trades, want me to make different videos on different setups, how to trade credit spreads, just drop a comment. And if you're still around watching the video, definitely appreciate a like as well. But that's all we have for today. See you guys.